Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In this tutorial, I will be sharing a simple yet effective swing trading strategy. Now, to keep the tutorial as educational as possible, I will be proceeding by steps. So first, I will be covering all the technical aspects of the strategy. So all the directional rules, entry rules. Then I will show how that can be integrated with the commitment of traders. Now, if you don't know what the COT data is, this is what the non-commercials, so the biggest speculators in the market are doing, which are essentially hedge funds, so the big players in the market. And following their orders can definitely be an advantage when you're looking to develop a strategy. And by the end of the tutorial, by putting together all the technical and order flow rules as well as the risk management rules, I will show and illustrate how you can create an entire swing trading strategy. So without further ado, let's jump straight into it. Okay, so first of all, we have to speak about technical rules. Now, when it comes to developing the rules of any kind of strategy, you always have to follow the three major steps, which are backtesting, demo trading until consistent, and only then you can start thinking about going live. Now, during the backtesting phase, this is where you actually develop all the rules of the strategy, because you can see how by adjusting different dynamics on your technical rules or order flow rules, or in general, the rules of the strategy, you will have different setups that get triggered at different times. So you will have different backtesting results. So this is one of the most important phases because you get to actually develop all the rules and adjust for maximum performance. Now, for this specific example of the swing trading strategy, what we will be using as directional rules, so in which direction we're looking to trade. So are we looking to trade in the bullish side or the bearish side, depending on how these parameters are met. We will be using EMAs and COT data, which is what I just explained in the intro, to understand in which direction we are looking to trade. Now, why exactly these two? Because these two are very effective when it comes to swing trading, because they help with the overall direction of the market from a swing trading perspective. So especially on the daily time frame, if the EMAs and I will now speak about which EMAs and the COT data are aligned to the bullish side, you have good probabilities of the market, especially from a daily perspective, to continue to trend to the bullish side. If they are aligned to the bearish side, you have high probabilities that the market will continue to trend to the lower side, so to the bearish side, meaning that in this case, shorts would be favored, while in this case, longs would be favored. So these two, we will be using them as our directional rules. Now, let's dive a little bit deeper. First of all, which kind of EMAs will we be using for this strategy? Now, when it comes to EMAs, especially for swing trading, I suggest the 10 and 20 EMAs. Now, how you can place them on your charts, just go here, you search for EMA, and you will see here moving average exponential. You can click on this twice so that you will have two EMAs here. Now that at that point, you can just click on them and adjust them to be the 10 and 20. Now, the 10 EMA, I like to have it in red because it is the faster EMA. And my 20 EMA, I like to have it in blue because it is my slower one. So as we can see now on the chart, we clearly have our 10 and 20 EMAs. Now, what this shows us is that if the 10, so the red EMA is above the 20, so they're cut for long, we have a market which is in a bullish state. So it's currently bullish from an EMA perspective. If they are cut for short, so if the 10 EMA is below the 20, like here, then you have a market which is currently in a bearish state, and we could expect more bearish continuation. However, that is not enough, because what we said is that we have both the EMAs and the COT data, which gives us our directional rules. So if the EMAs are cut for long, we would be only looking for longs. If the EMAs are cut for short, we would be only looking for shorts. However, What about the COT data? Well, the COT data needs to be aligning as well. Now, if we go here, for example, since this was Euro USD, we have to take Euro USD. What we have to check here is what is going on from a net positioning perspective. Now, if you look at this data, this is essentially institutions and hedge funds which are forced to report their positioning. Now, this software that we have, that I may develop, essentially automatically collects all the data and displays it here in an easy to read format. And what we can see is that you have the net positions here, which kind of summarize everything that you have already around this zone, because here you have how many longs you have from an institutional perspective, how many shorts you have from an institutional perspective, how many longs and shorts were added or closed with the last report, actually with every specific report, the percentage long, the percentage short, and then the net positions, which essentially averages out the shifts. So an easy way is if we're looking at the net positions and net positions are increasing, like for example, what was happening here, we went from having minus 47K net positions, meaning that we went from having more shorts than longs, all the way up to now having more longs than shorts with 134K net positions. So net positioning went from negative to positive. We now here have more longs than shorts with 237K longs compared to only 103K shorts. What this indicates is that institutions are shifting their positioning to the bullish side. So bringing back to our directional rules, if you have the EMAs cut for long and net positions getting increased from an institutional perspective, then you're only looking for longs. If net positions are getting decreased and the EMAs are cutting for short, then you are only looking for short setups. So you're only looking to sell. This is a very easy way to use two parameters to determine whether or not you will be only looking for longs on shorts. Then it's time to move to the entry rules. So where and when will you enter? Where will your stop loss be? Where will your take profit be? However, first it's important to clarify the directional rules. So just to recap one last time, if the EMAs are cut for long and the net positions are increasing, only longs will be taken. If EMAs are cut for short and net positions are decreasing, only shorts will be taken. So only sells. Now, let's move to the entry rules. Now, when it comes to entry rules, a very important thing that you have to understand is multi-time frame analysis, because you cannot look at the market only in one time frame. If you're looking at the market only in one time frame, then you are definitely very one-sided, because you don't really have a deeper insight on what actually is going on. Why is that? Because, for example, here you have a daily candle, right? One single daily candle, no matter if it's bullish or bearish, right? Let's say, for example, you have one big bullish candle, okay? We put it here in green. This is a bullish candle. Now, inside of that bullish candle, let's say, for example, this candle here is 1 day. Now, inside of 1 day, you have 24 hours, right? So if you have one daily candle, actually, if you switch time frame and you go from the daily time frame to the 1 hour time frame, inside of this daily candle, you will see so many bullish and bearish candles. You will see 24 different candles. You will see a lot of bearish movement. You will see a lot of bullish movement. So this means that essentially you will have a lot more data, a lot of more price action if you are looking at the market from different directions, essentially, from different time frames. You will have here 24 of these candles, okay, both to the bullish side and to the bearish side. So by looking just at the daily time frame, you have a very limited amount of data and structure that you can analyze in the market, because you have just one candle for every day. While if you're looking at the 1 hour, at that point you will have a lot more movements. You will have more intraday movements, right? And you can use the structure created from an intraday perspective to time your entries in the direction of the higher time frame, right? So the higher time frame will be more accurate in showing you the direction of the market. And for the specific strategy, we know the directional rules by looking at the EMAs and the COT data, right? However, when it then comes to the lower time frames, like for example the 1 hour or also the 4 hour time frame, there you will have a lot of structure that can be used to actually time your entry and use proper stop losses and take profits depending on the structure that you can see only on the lower time frames, because on the higher time frames you will not be able to see all that structure. So moving back here to our analysis, to our study of a potential swing trading strategy. What we can notice here is that most of the times the market will retrace to the EMAs, to the zone which is in between the 10 and 20 EMAs before then rejecting to the upside, right? Every single time that I have identified here with this red, by drawing it with red, the market retraced to the zone which is in between the 10 and 20 EMA and rejected to the upside. This means that in these zones, when the market retraces to the zone which is in between the 10 and 20 EMA, we have high probability of seeing a reversal higher, right? So at that point, once we look, for example, at the daily time frame, we see the EMAs cut for long. We see the net positions here that are getting increased from an institutional perspective. So we already know that we are only looking for longs. At that point, what we could do is go down on the lower time frames to use the structure that we have on the lower time frames to actually time our entry. That is why I have written here that when it comes to entry rules, intraday time frames, that is the way to go, because you have more structure. You can use that structure to time your entry and use proper stop losses and take profits. At this point, you have to define what your stop loss rules are and what your take profit rules are. Now, let's make some examples, because this video, this tutorial is all about examples, all about showing how to potentially create a trading strategy, essentially from scratch, right? So what we can see here is that, for example, at this level here, if we use the reply tool, we can see how the market here was testing the zone in between the 10 and 20 EMAs and then started rejecting it to the upside. So what we have to do is identify how we could have potentially taken advantage of this, because we have already decided our directional rules and here they are already met because EMAs are cut for long and the net positions were increasing. At this point, what we have to do is we have to understand how we could have taken advantage of this move to the upside from an intraday perspective. Now, what we could do in this case, for example, is go down on the 1 hour time frame. And if we go down on the 1 hour time frame, we can see that, for example, one of our rules that we could use is that we are looking to buy the breakout above the last high from a 1 hour perspective. So, for example, you know that the previous high is here before the market created this move to the downside. We could use a buy stop just few pips above the previous high, so that we know that our order will only be triggered when the market is ready to create the move to the upside and essentially shift from having a bearish structure to a bullish structure. Because always remember that a bearish market is a market which creates a series of lower lows and lower highs. A bullish market is a market which creates a series of higher highs and higher lows. So if you're looking to buy the breakout above the previous high, you're essentially buying the break from a bearish market to a bullish market. You're buying the shift from a bearish structure to a bullish structure. And if you know that from a directional perspective, you have good probabilities of seeing a rejection higher, which comes from knowing that directional rules are showing that, at that point, you would have good probabilities that the market could continue in your direction. So for example, a rule, this is just an example, a rule for entry could be buy stop above the previous high from a 1 hour perspective, because at that point, the intraday trend is aligning with the higher time frame trend, which comes from the directional rules. What about the stop loss? Well, for example, an interesting rule for stop loss could be to place it below the most recent low, because if the market here retraces below the previous low, at that point you have once again a bearish market, right? For the same dynamic that I have just explained here. So at that point, if the market shifts once again into a bearish trend, you wouldn't be interested in that setup anymore. So it's good that you get stopped out because you want to be out of the trade for the least loss possible, right? What about take profit? Well, take profit can be set on structure or can be just set, since this is a swing trading strategy, for example, to just be 1 to 3 risk to reward. So you're essentially looking to profit at least 3 times than what you are risking. Why I always suggest a minimum of a 1 to 3 risk to reward? Because if you have a 1 to 3 risk to reward, essentially you have the possibility to even lose up to 7 trades out of 10, so have only a 30% win rate and still come out on top and in profit. In fact, if, for example, you take 10 trades, okay, let's say, for example, you have 10 trades and you're risking 1% each, okay, you lose 7 trades, so 7 losses will equal essentially minus 7%, right? Because you're risking 7% per trade. So 7 losses will be minus 7%. However, you then have 3 winners. So meaning that you had a 30% win rate out of 10 trades. Still, you would come out on top with for the 3 winners, you would have plus 9%, right? Because you're essentially making 3 times than what you're risking. So every winner is 3%, while every loser is minus 1%. So this would equal plus 9%. So in total, you will still come out with a 2% profit, even though you only had 30% win rate. That is why I always suggest to have at least a 1 to 3 risk to reward. So let's say, for example, the arbitrary 1 to 3 risk to reward would apply here. We would be looking to target only a 1 to 3 to the upside. Now, in this specific case, what we can see is that the market, in fact, did continue to the upside, it seems. Let's see if it actually hits the upside target. And the market, in fact, did hit the upside target, giving us a 1 to 3 risk to reward. Now, what did we know that had a good probability of happening? Because from a directional perspective, the EMAs were cut for long. The CO2 data was increasing in net positions, showing that institutions were buying. And in a situation where you have institutions buying, EMAs cut for long, you have good probabilities to see more bullish continuation. Now, if the market, according to the rules of the strategy, would retrace once again to the zone, which is in between the EMAs, like for example, what it did here, you would once again be looking at the setup. For example, let's take something like this. You have a market which is now once again retracing to the zone in between the 2 EMAs. You know that the net positions are increasing. The trend is clearly to the bullish side, so institutions are still buying. There is a good probability from here to see another rejection to the upside, to see more bullish continuation. So according to the rules of the strategy, we just put down some easy rules. Going down on the 1 hour time frame, we would be looking to buy the breakout above the 1 hour high, essentially. Now, in this case, if we have a situation like this, where the market is trending lower, if the market is trending lower here, the previous high would be this one here, right? This would be the previous high from which the market started this move to the downside, meaning that if we're looking to buy the breakout, we would be looking to buy the break above this level. We would have a 1 to 3 risk to reward, which in this case would be exactly at this level. So let's see if the market here triggered above this zone. So what we can see is that the market did in fact trigger, and we did see more bullish continuation, and we also saw a nice 1 to 3 risk to reward. And we know that had good probabilities of happening because from a directional perspective, everything was very bullish. All the rules were satisfied. And also from an intraday perspective, we had the shift from a bearish 1 hour trend to a bullish 1 hour trend. I hope this tutorial was useful in showing you how you can develop a trading strategy from scratch. Always remember to follow the steps. First backtest, then demo trade until you are consistent with the set of rules that you have decided. You can always switch back to backtesting for more fine-tuning of all your rules, and only after you have already successfully proven yourself with that strategy, only at that point you can start thinking about going live. So I definitely hope that this tutorial helped. If you want to learn more, I definitely suggest that you go and check out transparentfxtrading.com. Here you have the possibility to gain access to my entire course with all the rules of the strategies. You also have the possibility to gain access to one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the CO2 data software, which is the one that we used in this tutorial, the trading station software, which puts together everything that you need as a trader all in one interface. And if you scroll over here past the testimonials, you will also have the possibility to join to gain automatically access with the email and password that you will create during the registration process. So I definitely suggest that you go and check it out, transparentfxtrading.com. You also find the link below in the description of this video. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis education and updates for all of you. And I will see you in my next breakdown.